Hey everyone, Scott here, and today we're going to continue talking about some tax strategies that you might be able to utilize to lower your tax bill to the IRS. So today specifically, we're going to talk about bunching your deductions and how that could save you thousands in taxes over the next 3, 4, 5, even 10 years. Then we're going to talk about how a withdrawal strategy can make a huge impact on your retirement plan. So let's get started. So bunching, let's get started with that. Now, remember a few years ago with the Trump tax cuts, they raised the standard deduction. So a lot of you are not able to itemize anymore. So you're not getting tax credit for your charitable deductions, for your mortgage interest, for your property taxes. Well, some of you might be really close. Now, the actual number is about $12,400 for someone that's single, and it's double that for someone married filing jointly, so about $25,000. So just for easy math, I'm going to say $12,500 for single, $25,000 for married filing jointly. So let's say that when you add up all your itemized deductions, you're coming in at, let's say you're married, and you're coming in at $20,000 a year. Well, that's really frustrating because it makes more sense for you to take the standard deduction of $24,000 and you're not getting any credit for the $20,000. But what if you were able to bunch 2 years worth of charitable giving, maybe even 2 years worth of property taxes into one tax year? So what that might look like is, here's your timeline. Here's 2021, here's 2022, and here's 2023. So let's say you were able to get, in January, you were able to give, and in December, you were able to give. The December gift is going to cover you for all of 2022, right? But it all happened in one tax year. So let's say when you add it all up, when you combine your charitable giving and maybe your property taxes, you have itemized deductions of $40,000 right there in 2021. Now though, let's say 2022, well, you just used 2022's charitable giving in 2021, so you can't itemize again. But that's okay. 2022, you just take the standard. So we itemize, we standard. Okay? Then 2023, you do the same thing that you did in 2021. You bunch your giving in January and December. You bunch those into another tax year, so now you have $40,000 in itemized deductions. So rinse, repeat. So what that gives you is, over a 3-year period, $105,000 in itemized deductions that you get to take off your taxes over those 3 years. Compare that to if you had just not done any tax planning whatsoever, and just, you had the $20,000 a year in itemized deductions that you couldn't take because it made more sense to do the standard. So if you had just taken the standard deduction all 3 years, 25,000 times 3, pretty easy math, 75,000. So that's a difference of $30,000 over that 3-year period. So what did that save you in actual dollars? Was it worth the effort? Well, take 30,000 times, let's say you're in the 22% tax bracket. What's 30,000 times your federal tax rate of 22%? That's $6,600. Is that worth saving? Is that worth doing a little pre-planning? $6,600 over 3 years? It would be for me. So, and then you just rinse, repeat that over a number of years, and you can save yourself quite a bit on taxes. Okay, so the next thing we're going to talk about is withdrawal strategies, and we're going to start with a couple. Let's say they're age 65 and they bring in $50,000 a year in Social Security, but they need $125,000 to live. Now this couple has done a lot of planning. They've done a good job of saving. So they have a few different buckets that they can pull from. The first bucket they're going to pull from is just a non-qualified, a brokerage account that they own some stocks in. They have some capital gains in there. So when they sell the stocks, they're going to pay some capital gains, or at least have capital gains. So let's say from that bucket, we're going to call it the just selling stocks. Let's say that gets them $30,000. So they sell $30,000 worth of stocks, but guess what? That $30,000 only had a $10,000 capital gain. Okay, so we're going to keep that in mind. To get $30,000, it only caused a taxable event of $10,000. So this couple also has a bucket of Roth IRA. And so they're going to pull from their Roth $20,000. Okay, so now they have $20,000 totally tax-free, right? If you use the Roth correctly, you get to pull it out tax-free. And then they also have traditional IRA. And they're going to pull $10,000 from there. Okay, now that whole $10,000 is taxable, right? Coming from a traditional IRA, they've never paid tax on that, so they got to pay tax on that $10,000. And finally, they're $15,000 short. Luckily, they have $100,000, a couple $100,000 just in a savings account at the bank. So they're going to pull that remaining $15,000 out of their savings account. So there you go. Now, they don't pay taxes when they pull that out of their savings account. They're just paying taxes on any small amount of interest they might be getting on it. So when we add all this up, that's $125,000. Okay? $125,000 in income for this couple, age 65, and what do you think their federal tax bill on this $125 is? $125,000 is. Their tax bill, when you add all this up, is my favorite. It's $0. And the reason is that the way Social Security is taxed, you have to have over certain thresholds before this becomes taxable. So until you hit those thresholds, which for this couple, the only taxable income they had was $10,000 in capital gains, $10,000 in traditional IRA, maybe some very small amounts in interest, but very, very small. So they didn't hit that threshold to where Social Security starts to be taxable. So all of this is tax-free, $20,000 of that's tax-free, all of that's tax-free. So then, when you add up their actual taxable income, it's still less than the standard deduction of $25,000, so they pay $0 in taxes. So, this is an extreme example. Not many people have enough in each bucket to be able to get totally tax-free income, but with a good withdrawal strategy, where you take from different buckets, you can absolutely lower your tax bill and get as close to this guy as you can. Hope this helped. If you learned something here, give us a like and subscribe so that you get these videos to your email as soon as we post them. And we're not going to be emailing every single video we do out, so I'd appreciate if you subscribe. And until next time, you can go check us out at Carl's Corner. Go to carlsonfinancial.com. Up in the corner, you'll see our past videos. And if you need help with any of this, if you haven't gone through any of these strategies, give us a call, 844-CARLSON, or check us out at carlsonfinancial.com. Until next time, have a great day.